All right. Well, good evening, everyone. My name is Jason Reminick. I am the CEO and founder of Thalamus. It's my pleasure to welcome you all to the second part of our Gear Up for Residency with Thalamus webinar series. We're joined by the Physician Loans team for a Physician Loans webinar on one-on-one on physician loans, which we're really, really excited about tonight. Again, to kind of give you the intro to Thalamus, if you joined us for the first webinar, if you are joining us for the first time, and if you were here before, welcome back. Story of Thalamus is I was a residency applicant in 2012 to 2013. Was applying to residency and got stuck in New York City during Hurricane Sandy, and all of my interviews were canceled. And so that was really the catalyst for the creation of Thalamus. Now, many years later, or a decade later, we're just in our 10th anniversary year. We've worked with thousands of programs and hundreds of thousands of applicants. And I know many of you, or essentially all of you, would have used our application services through our interview management services through the 2024 match. Just to give you some background on kind of who we are and what we do, we were founded in 2013 by GME for GME. In addition to myself, my co-founder is a program director and associate DAO at the University of Rochester. Her name's Susie. We have an entire team of program coordinators, directors, applicants, GME leadership who have worked in GME and are passionate about GME, combined with software engineers and product experts and everyone else that helps us build our software. Our team, as you can see, is continuing to grow as we grow, particularly alongside the AAMC collaboration with over 7,000 programs using us over the last year, and many more, hopefully, in the upcoming match. Our team has grown. The bottom picture there is now our current team at our most recent all-hands retreat out in Austin, Texas, a few weeks back. But we're a very mission-driven organization, really focused on the social impact to close gaps of access for all and increase diversity in medicine. We converted to a public benefit corporation back in February as well. And we do a lot of research throughout the match and the transition to residency related to how geography impacts the match and various trends and market changes in supply and demand throughout the match as well to track that year over year. One of our main goals has always been to provide really tools for applicants to streamline this transition. It started with our software, but kind of where we're looking to go in the future is just to kind of extend that reach and provide additional resources along the way. And one of the ways we do that is through a sister nonprofit organization that we founded called Thalamus.org, which provides financial assistance in the form of grants and scholarships to medical students who are underrepresented in medicine to navigate the transition to residency. We provided over $40,000 in scholarships to 10 medical students over the past year, and have partnered with AMSA and the ADC Scholarship and others as well. This was our team at the AAMC's Learn Serve Lead Conference in Seattle, or select members of our team from back in November. And so we're really trying to provide ways to solve a lot of the challenges in this process. And in getting together with our team, and after getting feedback from applicants along the way, we've worked with several different organizations. And I, being a physician and a former applicant, have used several of these organizations or have relationships with these organizations. And so we put together a curated list and this webinar series. We kicked it off the other night with Doc to Doc, in terms of 6 ways you're wasting money, which is a lot about financial planning and just money management as you head into training. Tonight, we'll work with the Physician Loans team, and we'll get into that in just a second. Then we'll take a week off for the Memorial Day week. And then from there, we have Practice Link on June 6th, which is a physician job board and recruitment company. We'll be talking about First Practice, which is their resident and fellow career guide. And then we'll close out the series with Doctors Without Quarters, proven strategies for managing student debt. And so we really tried to put together an entire webinar series of just various important pieces at this stage of your life as medical school is wrapping up, and congrats on that. And wherever you're headed next year, we look forward to supporting you through that as well. If you're coming and applying to fellowship, you'll very likely be using Thalamus in the future again too. And so we want to continue to provide resources. We're very applicant focused. We don't charge applicants anything for our services or this series or otherwise. And also, just to kind of add additional incentive, For each webinar session that everyone attends, you gain an additional entry into a raffle we're doing to reimburse someone's residency application fees by Thalamus. And so you can see and register for the additional items through the Eventbrite links that you've been provided prior, or using the link at the bottom as well. And so really just overall excited for this series. I'm particularly excited about Physician Loans tonight. I'm joined by Tal Frank, who's the president of Physician Loans. We've known each other for several years. I've really benefited from a physician loan to help purchase my first property. I didn't know Tal or Physician Loans at the time, and kind of had to go the conventional banking route, which was an adventure on its own. I'm a big believer in Physician Loans because it really provided me a lot of financial freedom in my life and allowed me to also purchase a property. And so having met with Tal and his team over the years, have just been really impressed with their services overall. Is incredibly knowledgeable about the physician loans and has close to decades of experience at this point. And so I'll turn it over to Tal. I'm excited to provide kind of my insight and what's happened throughout my early stage of my career as well, and really just looking forward to the discussion overall. So Tal, welcome. Really thrilled to have you here, and I'll stop sharing my screen so you can pull up your deck as well.
All right, very good. Thank you. I'll pull up mine. All right. And you're seeing my screen okay there, Jason?
Yep, all looks good.
All right, very good. Well, good evening, everybody. Welcome. And as Jason mentioned, my name is Tal Frank with Physician Loans. Jason, I must say that, that's an impressive intro. Yes, I knew you, way back when, say Thalamus was a little kid. And, to see how that's developed and grown over the years, very, very impressive. So proud to be associated with this, and certainly on good terms there with you, and being able to both share information that we know is greatly needed within this community. So what we're going to talk about is buying a home as a new doctor, as a new resident. And I'm not really here to talk about myself, but I do think it's important to understand a little bit of our origin and how we got here. And I'd like to start with this photo on the right-hand side, where that's me sitting down, and behind me is one of my younger brothers and our parents to our left. And this is at his match day ceremony at University of Cincinnati, again, many, many years back. And what's interesting is he matched to a program in Florida, looked at properties with an agent, found a condo that he liked. And when it came time to get financing for that condo, he was not able to do that as a graduating med student going to residency. Now, what's interesting is my family and I, we already had a mortgage company. We were in the business, and we had no idea that this was going to be such a challenge for him. And, similar to Jason's story about the evolution of Thalamus and how it came about, same type of scenario for physician loans. So what we did is, first of all, our parents had to personally get involved with the mortgage to help my brother get a loan. But then what we did is we researched this a little bit, and we pioneered a special mortgage, a special home loan for doctors. And we started by focusing on graduating med students and residents. Back then, our name was Tower Mortgage, but this really took on, obviously there was a need, and we switched the company name to Physician Loans, and again, retooled the company to focus solely on the medical community. Fast forward 20 some years. We were recently acquired. So we were an independent family business. We were recently acquired by a bank that now allowed us to be national. And we are the specialty division for mortgages for doctors within the bank. I don't like to brag too much, but I do like to point out my license number, which you see on the screen there, 6502. Most folks in the industry today have 6, even 7-digit numbers. So been at this for a really, really long time, still loving it. You know, education is how we launched into the space with physicians, and still love doing that. So with that, let's take a look at what we're going to cover today. We'll talk about the market and about home loans and steps to take. A little bit of a challenge today is I know that we have a little bit of a mixed group in that some of you may have recently closed on a home. Some of you might be in the process of trying to buy a home. Some of you may have had a recent mortgage go south and unravel, and you know, you're looking for how you actually go about financing a home as a graduating med student. So we're going to cover information that is both high level, and we'll get into the weeds a little bit and try and cover it appropriately for this audience. Most importantly, you see the final bullet point, which I've highlighted here. I not only allow the Q&A throughout, I highly encourage it. So at any point in time, you can either type in a question into the Q&A there. And joining me is Danny, who is another one of my brothers. This is not the one that is now a physician, but he's also in business. And he and I ran Physician Loans, took it over from our parents, and we're now part of the bank as part of the acquisition. So he'll be addressing the questions behind the scenes. You are also welcome at any time if you'd like to unmute yourself and ask a question that way. And don't be shy. Again, been at this for well over 20 years. Anything goes. Your question doesn't even have to relate to what slide is up at the moment. So if a question comes up, I want to help. I want to help out, answer any of the questions that you have. So enough of the housekeeping and the intros. Let's get into it. And I'd like to start with a little bit of an overview, because this is not meant to just be a how-to. And by the way, this, I might mention this a few times. I don't come into these types of sessions and say that you have to buy a home or that you should buy a home. I go through the landscape, show you how to do it, also a little bit about the decision factor of buying versus renting. And the truth is, some of you may end up renting for most, if not all, of your residency, and that's perfectly okay, and you can buy on the other end. So this is really meant to be informational and help you decide what works best for you. And if you decide to buy, then at least you know what you need to do and how to avoid some of the pitfalls that happen to the young or newer doctors that don't take the right path. So one of the sources that I go to for my data is FHFA.gov. So this is one of the slides from the most recent quarterly report, which is the Q4, fourth quarter of 2023. The first quarter of 2024 is not yet ready, not yet published. So this is the most recent quarterly data that they have. And what you see is they've been tracking home values across the country since 1991. Clearly, you can see where 2008 happened, and there was a a depreciation of value for a number of years. Markets recovered. What I want to focus on and why I bring this slide up to start with is notice since 2020, since June 2020 on this chart, the slope is a lot steeper, meaning home prices have appreciated at a much quicker clip over the last several years. So why is this important to you as a potential buyer? Well, a few things. Home values have gone up, making homes a lot more expensive, which is a challenge for the early stage career physicians, right? Rates are also higher right now than they were several years ago. You used to have rates in the threes, now they're sevens plus minus. You also have a challenge with very low inventory. So that, rates were increasing pretty steadily over the years because rates were so low. And because there's low inventory, that is causing, certainly a seller's market there where there are more buyers than there is product. So one of the pieces of advice that I have is how you combat this is start the process early. One way, and we'll go through the two professionals you need to work with, which is a loan officer and a real estate agent. But one way is to start tracking the market early, because again, I know some of you are going into residency or going into a one-year internship position, and then you'll look at buying next year. If you know where you're going to be next year, it's not too early to develop a relationship with a real estate agent and start tracking the market. Sure, you can go to Zillow.com, you can go to Realtor.com, number of sites you can go to look up property values, but a good real estate agent is going to sign you up for a portal that gives you near real-time information as they have, and certainly more accurate than some of the other aggregators of that information. So start early, develop a relationship with the real estate agent, track the market. I don't have a slide for this, but one resource is DRS Agent. This is a network of agents across the country that will, they specialize in working with the medical community. Certainly you can ask within your residency department, a number of ways, but just make sure I will be talking about this, finding the right professionals to work with. Another slide, this shows the information in a different way, also from the FHFA report, where you can see each year what home prices have done. So for those residents who are selling their home now, after being in it for the last 3, 4, 5, 7 years, they're loving it because they're going to be making money on the sale of that home. However, chances are they're also buying a home and probably buying a more expensive home. So they're buying into a very expensive market as well. I see Jonathan asked a question here. Does this market tracking, so you're referring to the portal that I mentioned, does this market tracking with a real estate agent in a certain location cost introductory fees, or can we get free consultations? Jonathan, I'm glad you asked that. Very good point. You do not pay for that. The way a real estate agent works is that you can talk to a real estate agent. They can give you all the advice they have to offer, answer all of your questions. You might actually go somewhere, fly out, drive out, look at homes with them, spend a weekend looking at properties. You might end up deciding not to buy. You might not find anything. You don't owe them anything. So there are no upfront fees there. And that's why I said, start early, track the market. If the time comes, to buy and you just don't see anything you like, that's fine, but no cost whatsoever. All right, continuing on with FHFA, again, just so you get a little bit of an idea of the landscape, because I know there are many who, again, not buying right now, but some point over the next 6 to 12 months. So FHFA goes from national to state, and you can see the bottom. This is the first page of this two-page chart. The national average shows that homes have appreciated about 6.5% over the last year, about 60% over the last 5 years. So this is good, interesting information, gives you a general idea of where things stand. But you still need to drill down even deeper for it to be more relevant for you. So further into the report, now you have the top, I believe it's 200 metropolitan statistical areas, meaning cities, which is typically where you have your residencies, and you can see what each city is doing or has done over the last year, over the last 5 years. And as you can see on this page, there are some places that have finally started to slow down a bit with this crazy appreciation, which it's not sustainable. That level of appreciation has to slow down. So you can see Baton Rouge, Louisiana, pretty much even over the last year, minus 0.68%. So again, as you look at where you're headed, if you want to visit FHFA.gov, that's a great place. But again, you speak to a real estate agent, they can give you this information as well. And in fact, even looking at this information, it's still very broad, right? To look at, little way more than halfway mark, you've got Chicago, Naperville, Evanston, Illinois. That's a huge market, right? So it's good to know in general, but that portal that I was talking about, that real estate agent, you can put in a zip code, you can put in a school district, you can put in put a pin on a map for where you're going to do residency, draw a 2-mile, 3-mile radius, and say, everything in that area. So that's going to give you the real granular information that you want, and will allow you to track it so that once you are ready to make an offer on a home, you and your real estate agent will have a game plan as far as, how aggressive can you be? Maybe you can't be aggressive. How does it compare to other places in the market? If you've been tracking it for a few months, if home values, have been coming, or the asking prices have been adjusted downward, or you'll be able to see if people are getting their asking price. Because once a home closes, it takes about 30 days or so, but then you'll be able to see that information. So all good to know for any future date when you plan to buy, just some of the strategy. So now what we'll do is let's talk a little bit about the types of loans that are out there. And again, understanding we've got an audience here that might be in different stages of either looking for mortgages, will be looking for mortgages, had a problem with a mortgage. We're going to start high level. Any loan that you look at probably most likely has to fall into one of these 4 buckets. We can get technical and say there are a couple other unique or other specialized loans out there, but they don't really apply, like a rural housing loan. I don't think any of you in residency would be buying a lot of acreage, right? So it has to fit into one of these 4 categories. And we'll start with the left-hand side here with a physician loan. So there is something called a physician loan. It's something real. It's what I mentioned we pioneered over 20 years ago. It is a special mortgage for the medical community, and it allows a doctor with good credit to buy a home with no money down and no PMI. PMI is private mortgage insurance, also known as MI, or mortgage insurance, which is something you typically have to pay on a mortgage for a policy that protects the lender should you default. Well, the reason we were able to create a special mortgage for doctors is because it's known that doctors with good credit are not likely to default on a mortgage. So we're able to do something that's different. So the no money down, no PMI is kind of what everybody sees or reads about or thinks about when they see a physician loan. The real benefit is under the hood, meaning the underwriting guidelines. And I'll get a little bit more into that shortly, but there are some very specific factors that cause a graduating med student or even a resident to not be able to qualify for some of these other types of loans I'll cover. So a physician loan is something unique. It is not offered by every company, every lender, every bank, every mortgage company. While we pioneered it, I'd love to say these days we're still the only one, but we're not. There are others in this space, but it's not as many as you'd be led to believe if you just go online. There are websites out there that will list companies that offer a physician loan. Usually those are advertising sites. So I bring this up so that you know as the consumer how to navigate that and how to go down the right path. So you're getting what I call a true physician loan, not a faux physician loan, because then you could have some problems as you get closer to your expected closing date. We'll come back to that. Moving away from doctors, moving away from a physician loan, the most common, let's call it vanilla type of loan in the US is what's called a conforming loan. You have to have very good credit scores. You have to have a certain amount of down payment. You do pay PMI unless you put 20% down. Now, one way of looking at a conforming loan is that as a borrower, you conform to the guidelines established by Fannie Mae and Freddie Mac. Well, Fannie Mae and Freddie Mac, they're the mortgage equivalent to, say, a Sallie Mae in the student loan world. They buy a lot of the mortgages that get originated across the country, whether it's a large bank, small bank, credit union. So those institutions, mortgage brokers, those institutions will only give you a conforming loan if they know they can sell that loan to Fannie Mae, Freddie Mac down the line. We'll come back. I know I've now said this a few times. There are reasons why a graduating med student and resident don't qualify for conforming loan. We'll get back to that shortly. So we'll put a pin in that. FHA is a loan that was developed to help those with lower credit scores. It was designed to help improve home ownership. So it's a good loan, but it's going to be more expensive than a physician loan or a conforming loan because it's a riskier pool of borrowers. So when it comes to closing costs, physician loan, conforming loan are going to be pretty much the same. The FHA loan, the fees are going to be higher. There are additional fees. And because it's a riskier pool of borrowers, it's also a more expensive loan for the PMI, for the insurance, because there are more defaults. So again, it's not that an FHA is a bad loan, but just as we're comparing, contrasting, it's going to be more expensive than conforming or a physician loan. When you see companies out there, they'll try to market a physician loan. Oftentimes they're kind of rebranding an FHA loan, but then they'll tell you, yeah, you need a parent as a co-borrower in order to qualify. Because again, the FHA guidelines are still, they're a little relaxed, but similar to Fannie Mae, Freddie Mac. Then there's the VA loan or Veterans Administration loan. And as the name implies, it's for eligible military. I don't get into too many details. It's kind of a subset within the niche. So, but feel free to ask if it applies to you. But one of the main benefits of a VA loan is that it also does allow for no money down, same as the physician loan, but it does have expensive mortgage insurance in the form of what's called a VA funding fee. So these are the four loan types. As a consumer, as an informed consumer, you should know which loan you're being sold, regardless of what it's called, because they're not marketed necessarily as, oh, this is a conforming loan. Might have a different title label something, but under the hood, you need to know what it is. In addition, there are legitimate loans out there sold as what's called a first-time homebuyer loan or a hero loan that is for first responders, teachers, and so a lot of graduating med students or residents will think, oh, those two loans could apply to me. They could, but they are modifications on a conforming or an FHA loan. So again, once you get deeper into the underwriting, oftentimes those end up falling through. So, I've now mentioned a few times that there are challenges for graduating med students and residents, and I'll just quickly highlight a few of these reasons. And one of them has to do with your student loans, not the fact that you have student loans. It's the fact that as a graduating med student, once you graduate, you've got your 6-month grace period. If you're trying to buy during that period, you don't have proof from your lender. You can't get proof from your lender on what your payments will be for the next 12 months. You can apply for a payment plan, but you're still in that grace period, so you are not yet in the payment plan. So what a physician loan does is it allows you to, well, what we do is we basically do not require any documentation from your student loan servicer. What we do is we just assume a save payment. So we put that into our calculations. Now, once you are in residency and making a payment plan, then we can use those. But for some lenders, even that's a challenge, because you might already be familiar with this, that your payments are 1 year at a time. They're set for a 12-month period, and then they would adjust. And a lender wants to know what your payments will be for a full 12 months. But if you're in the middle of a cycle, your lender may not be satisfied knowing that, okay, this is your payment now, but it might change next year. So again, student loans can be an issue. I see Caitlin sent in a question here. Is the physician loan or VA loan more beneficial overall? I have access to a physician loan, and my fiance has access to a VA loan. So there are a couple of ways to answer this, Caitlin. Another great question. My recommendation, first of all, what you can do, I'll tell you what my answer is, but I'll tell you what you can do. Don't listen to me. Just if you talk to a loan officer who offers a physician loan and a VA loan, have them do the two side by side, run the math. Let the math decide. If you truly qualify for both, then see side by side. Having said that, usually the physician loan is going to come out less expensive because it has less fees than the VA loan, and it does not have that mortgage insurance that I mentioned, which is in the form of the VA fund. It's called the VA funding fee. Usually the physician loan is going to be the overall better value. So I hope that helps out. And by the way, anytime you guys ask a question, I'll do my best to answer. If I kind of miss the mark with something, please follow up question, and we'll keep at it until I get it right, okay? So another challenge for a graduating med student is not having proof of employment. Once you match, you get a match letter, but if you show that to a traditional lender, it looks like a offer letter, right? Congratulations, you've been accepted, salary start date, but it's not an actual employment contract, and you don't have pay stubs. Usually the employment contracts happen later in the year. In fact, I would bet, if we were to poll the participants right now, you've matched, but you still don't actually have a fully executed signed employment contract, meaning a contract that's signed by you and whoever needs to sign it on behalf of the residency program. So proof of employment is a challenge. Also, trying to buy the home before you move. This is true whether you are a graduating med student going to residency or moving from an internship year to now your 3-4 year residency. A physician loan understands that, has it built in, and allows you to move early. And then there are things like the medical license. Let's say you're headed from Florida to Tennessee, and a traditional lender will say, oh, you're planning to be a resident, a doctor in Tennessee. Surely you have a medical license. Well, you won't when you're applying. So again, a physician loan is, let's call it, calibrated to adjust for the unique needs of a graduating med student and resident. So one of the things I created is this cheat sheet, which you are welcome to use. I will make this deck available, and any loan officer you're speaking to, ask among the first questions, ask these 6 points, because if you're getting any type of hesitation or hemming or hawing, that's anywhere from a concern to a red flag. Meaning, if you're asking about mortgage insurance and they say, well, we're able to avoid it, the answer should be no. This loan has no mortgage insurance if it's a true physician loan. And the reason I say that is because there are ways to structure the PMI payments in such a way where it's paid in other ways, but it's still PMI. So it's called maybe a lender paid mortgage insurance, or you pay a larger premium up front. There are different ways to structure it. So ask about each of these items to make sure you're on the right track. So with that, now we can talk about the timeline, what to do and when. At a very high level, once you start the process, let's say you get approved, you find a home. Once you are approved with the home, you can typically close within about 30 days. So expect about a 30-day timeline, plus minus. Now, having said that, usually you're not just starting everything last minute, right? So the way this works is, let's say you want to buy a house later, close say in July. So step number 1, you select a loan officer. The reason you do that is to get pre-qualified. You might have heard pre-approved or approved. That term is used interchangeably between different companies. But you're speaking to a loan officer. By the way, it doesn't cost you anything to talk to a loan officer to get pre-qualified. There should be no application fee, and you can ask as many questions as you want, and really feel comfortable with your process, with the loan officer, with monthly payments, and that you want to move forward with a purchase. But ideally, reach out to the loan officer anywhere from 30 to 90 days before you plan to really start looking for a home. If you want to work with us, PhysicianLoans.com, you can type in, there's a short form there, you put in your information, and one of the loan officers on our team would reach out to you. And again, although the bank as a whole may not do loans nationally, our team within the bank will work with you nationally, outside, except for Hawaii, Alaska, and New York. But that's one route for a loan officer to get started. Usually to get pre-qualified, it's about a 1-2 day period, depending just on how busy things are. But it's a pretty quick, not too difficult process. Your next step is to reach out to a real estate agent. And the reason you start with a loan officer is because one of the first questions a real estate agent is going to ask you is, are you pre-approved, right? The real estate agent wants to know that you're qualified to buy a home before they start showing you homes and spending time. And they also want to know what's the correct price range that you should be looking at. So again, you can ask through your residency program. You can go through the resource that I mentioned, but one way or another, you want a loan officer or real estate agent that you trust. That should be your dream team to really help you with that process. Now that you have that, You can start looking at homes and get under contract. Once you are under contract, as we said, plan on about a 30-day closing. If you need more time and the seller's willing, you can, that's all negotiable, but it takes about 30 days to close. There are a number of steps that still need to happen, and a loan officer and a real estate agent will walk you through the process. So if you find a house, let's say in mid-June, you can expect to be able to close mid-July or so. For those of you who will be renting for your first year of an internship or residency, and you plan to buy next year or next summer, then what I would recommend is you start the process either January, February, March with both a loan officer and a real estate agent. Make sure, track the market. We're not expecting a glut of housing to come online, and we're still expecting a shortage next year. So you still want to get a jump on the research, track the homes, and you would most likely be making an offer in March, April, or May for a May or June or July closing. So that's how the timing would work for next year. Before I get to the question that came in, I do include here questions to ask the loan officer about themselves and their process. I also have questions to ask the real estate agent about themselves and the process. You don't have to ask them every single one of these questions. The reason I put these up here for you is so that if you don't know what the entry point is or what you might want to ask, then this kind of gives you a guide. But the reason you want to ask these questions, guys, you're the consumer. You're the one in control of who you select to represent you. And what's more important than the answer they give is how they answer, right? Are they taking the time to work with you? Are they being patient? Are they guiding you along? Or do you just get the sense that they're a salesperson just trying to make a buck? And yes, the loan officer and the real estate agent, when the loan closes, they do make money off the transaction. And that's okay. That doesn't mean you can't trust them. I like to point out to people that my doctors make money on me, and I'm okay with it, right? But I select doctors that I trust. I select mechanics that I trust, plumbers that I trust. Any professional, you've got to hire a professional now in life, right, as an adult, and you're going to select someone who you trust and should be giving you the best advice possible. That is in your best interest. And I see a question came in. Oh my gosh, apologize if I'm not going to be pronouncing this correctly. Shaya, that's my attempt here. Is a physician loan an option for residents who are on visa? It is. Yes. In our case, we do allow the now. Depending on the type of visa, you can ask about the H-1B, you can ask about the J-1. So there will be some changes in guidelines from time to time, and there could be some other requirements as well, but it is possible. You do need to be considered a permanent resident alien. And again, the loan officer would walk you through kind of the requirements, but there does also have to be a history of residency in the US with established credit. But it is possible. Now, that I will say, again, not necessarily just trying to talk about ourselves, but that is something we have that's unique, and something that we do that not necessarily other lenders who offer a physician loan, who offer a physician loan do, but bottom line, it's possible. So let's take a look now at some numbers of how do we determine how much you can afford. Single resident household, typically will qualify or will buy a home up to about the $300,000 range plus minus, and that's translates to payments of up to about $2,000 to maybe $2,500. If you are a dual income household, meaning one of you is the resident and the other, I mean, could be a resident, doesn't have to be, then you combine the incomes to qualify for more, and then you're looking at $400,000, $500,000, $600,000 plus, which for those of you on the call who are in modestly priced Midwestern cities and you think, what kind of a resident needs a $600,000 mansion? Those of you in Boston can let them know $600,000 just buys you a small condo, right? So yes, a resident might need a $500,000 home, not because it's anything fancy, just because that's how the market is in that area. Oops, there we go. So how do we determine how much you qualify for? And this is where we talk about what's called the debt ratio or debt to income ratio. Very important concept, whether you buy a home or not. This will follow you for the rest of your careers as you look to buy equipment, buy a practice, finance ownership in a practice. You know, anytime you're going to get a loan for something, the debt ratio is looked at. So for your housing, it's your debt payments, your month. Notice I didn't say it's your total monthly debt. It's your payments, your monthly payments on your debt divided by your monthly gross income. Each loan type allows for a different debt ratio. That's why on that cheat sheet, you may have seen this. One of the questions you ask is, what is the debt ratio that's allowed? A physician loan allows for the highest debt ratio, a true physician loan, in order to make it more possible to buy a home. And that's why if you ask about what's the debt ratio and the answer you get is 41%, then you know it's some form of a conforming FHA or loan and not really a true physician loan. But going back to the calculation here, so assuming you're working with a loan that allows a 50% debt ratio, if your monthly gross income, meaning pre-tax, is $5,400, it means you qualify for total debt of $2,700. Let's assume a beautiful thing, no debt, right? No student loans, no car loans, no credit card balances. That means all of your debt could be your mortgage, meaning you'd qualify for a mortgage monthly payment of up to $2,700. If you have several $100s of student loan payments, a car loan, some other miscellaneous personal loans, let's say $700 worth total, now you're looking at about a $2,000 availability for a mortgage. And so when you reach out and talk to a loan officer, that's one of the first exercises that a loan officer will do to help you determine what you qualify for and the price range of homes you should be looking at. So the way this works is the lingo you're going to hear out there is PITI, principal, interest, taxes, and insurance. Whatever house you buy, you're going to make a principal and interest payment. This is how much you pay based on what you borrowed and the interest rate. The taxes are the real estate taxes. Any property you look up online, you should be able to see what the annual tax bill is on that property. You'll be paying 1/12 of it every month with your mortgage. And then there's the insurance, homeowner's insurance in case of fire, damage, not to be confused with the mortgage insurance we talked about. And a loan officer will go through this with you so that, again, you can zero in on the right price range of homes. By the way, you're the consumer, you select the insurance company. So whichever Super Bowl ad, you're most impressed with, that's one way of shopping. You can call up that company and ask them about coverage. If you already have renter's insurance or some sort of insurance, you can see if they will write a policy for homeowners in the state where you are headed. And a loan officer will go through as many of these types of scenarios as necessary, as you see here, to be able to zero in on the payment you're comfortable with and to show you what you need to buy a home. I see we've had a few questions come in. Why does everyone say that millennials won't be able to own a home? Does this apply to us? Uh, yeah, I see. Danny, I see Danny typed in. Yeah, some of it is clickbait, to get people to read. But what they're talking about is a general increase in the home prices, right? There are mortgages we did 5, 6, 7 years ago that might have been a $150,000 home, which is very manageable for a resident, even on the lower salaries that residents made back then. But today it's in the 200s and could even be approaching 300,000. So what they're talking about is the general increase of home values, making it a little bit, well, maybe more than a little bit in some cases, just making it tougher. So this was, Lily, you also went on to ask, also how do projected interest rate or projected interest rates, how does that change all of this? Another great point or question. The answer might seem counterintuitive, but if rates go down, it could actually make the market a little bit tougher for you. And I'm not saying we don't want it to go down, but when rates are higher than what people are used to, they're sitting on the sidelines. When rates come down, and there's a formula or kind of a correlation in the industry, for every 0.5% or percent that the rate comes down, X millions of more people decide, you know what, now's a good time to buy. So rates going down means the money that you borrow will be cheaper, but it also means there will be more competition for the same homes, which then also in turn drives up the value of the home and makes it tougher to win out to get that contract. So the general advice is it's tough to time the market, right? If it's a good time for you to buy, talk to a loan officer, talk to a real estate agent, see if it's possible, see if it's feasible for you to buy, and then buy what you can afford at that time. Trying to time the market, is just like saying, when's the best time to buy any particular stock. Tell you what, let me advance with this section here, because this kind of relates to some of those questions coming in. How do I determine if I should buy or rent? And really, this Venn diagram speaks to what I was just saying, where is it possible? You want to determine if it's feasible to buy, and you do that by talking to both a loan officer and a real estate agent, and you make sure that what you qualify for intersects with what you want or need to pay or feel comfortable paying, and that intersects with what the local home prices are. If after talking to a loan officer and a real estate agent, you realize, yes, this is your scenario, then at least buying is an option. If you find that this is your scenario and the home prices are higher than your household salary can afford, then you may not like the answer, but it means you have to rent. There's no choice. And again, that is perfectly okay if you go through residency renting because of where you're doing your residency. So the city is really the number one factor. Another factor is the time in the home, as far as then deciding to buy versus rent. The rule of thumb in real estate is the longer you plan to stay put in one place, the more it makes sense to buy versus rent. For those of you going in, that are in a 1 or a 2 year program, just rent, period. It only makes sense to consider buying if you're looking at staying in a place for 3 years or more. 4 years makes more sense than 3, 5 years more sense than 4, and so on. Then you've got the lifestyle. If you're not ready for the responsibility that comes with ownership, that is perfectly okay. I like to say your goal during residency is to survive residency, right? You're not getting rich. You're not amassing your wealth. Don't let people talk to you about your home being your investment, right? So you decide what is best for you. And if you don't want to deal with maintenance, rent until you are ready. Maybe you don't mind some maintenance, but not everything inside and outside. Then you're a good candidate for a condo, or a townhome. And that's a good discussion to have with the real estate agent who would point you to types of properties in, that would suit that lifestyle. And then the final point has to do with the financial benefits. So yes, there are financial benefits to buying a home. And we're going to go through that. I love this slide, but I want to preface this next slide by saying, again, I'm repeating myself, it's not because I'm advocating home buying at this stage of your careers. And I take that one step further. Any loan officer or real estate agent that you speak with who tries to tell you you have to buy a home right now for the financial benefits, in my opinion, that's a red flag. The goal is to buy properly, and that, yes, you will come out ahead on the end of it, but on the other end, but again, this is not an investment. You'll have plenty of time for investments and all that, post residency. But it's important to understand the principle. So what I did here is I compared renting a place for $2,000 a month to buying a place that also runs about $2,000 a month. In both cases, you spend about $96,000 over the course of 4 years, right? But when people talk about the benefits of home ownership, what they're primarily talking about is building the equity, meaning building your value in the home. So in this example, if you bought a $290,000 home and we lent you the full $290,000 using a zero down physician loan, yes, it's your home, but you own 0% of it, right? Like zero equity. Now, every month that you make your PITI payment, you're paying down part of the principal balance. So over 4 years, you would have paid down $16,000. So 4 years down the road, when you go to sell the home, hypothetical scenario, let's say you sell it for $290,000. There are no other fees associated with it. You get a check for $290,000. Now you don't get to keep the full $290,000. You pay us off the balance, which is now less $16,000. And you get the remainder, you get the difference. So when people talk about why rent and pay the landlord when you can own and pay yourself, this is the concept that's being referred to. Then there's the appreciation, which is the increase in value of the real estate. Over time, historically, homes or real estate will appreciate in value. There will be ups and downs, just like the stock market, but the longer the term, the more likely it is to have appreciation and increase in value. I use in my examples a very conservative 3% appreciation. Would not be prudent to use, the 7, 8, 9 or double digits that you would have seen over the last several years in many markets. So assuming just a 3% annual appreciation, it means your home is worth $36,000 more when you go to sell it. So you come out $52,000 ahead in this example, buying versus selling. But there are two things that chip away at that. There is, remember, maintenance. You're responsible for maintenance, upkeep, and repair. Real estate rule of thumb is to budget about 1% of the value of the home, depending on and you can modify that based on the condition of the home when you bought it. The bigger ticket item, though, is the selling costs, primarily the real estate fees. As this buyer, we mentioned you're going to choose a real estate agent to represent you. You don't pay that agent anything, even at closing. At closing, some of them will charge a small administrative fee, but they're going to tell you about that up front. But again, you only pay that at time of closing. Otherwise, the seller pays both real estate agents. They pay the buyer's agent and the seller's agent from the proceeds of the sale. For those of you following the news and you're familiar with the recent lawsuit verdict regarding National Association of Realtors, yes, will be appealed. Who knows where that will end up down the road. That could change things down the line, but for right now, it's typically 6%, all paid by the seller, divided by, split between the two agents. So taking those into consideration, you've got a net difference here of $23,000, which is not insignificant. It's a nice amount of money, But again, you're not buying a home during residency with the goal of trying to make more money. We hope it works out that way. Worst case scenario, we hope you break even at least, which is why you don't just buy for a year or two. You want to be in there at least 3 years or more to help pay off or see more appreciation, and you're working down the balance. Most of you aren't going to do this type of an in-depth analysis to decide if you're buying or renting, but I like this because it's the financial literacy piece where it just teaches you about principles of home ownership. So if we wrap all this up together, the key to maximizing your chances of success will be selecting the right loan officer, selecting the right real estate agent, making sure you're getting put into the correct loan. I'm not going to lie, it is a tricky real estate market right now for buyers, not even just millennials, for everybody. Low inventory in some markets, there's competition, for especially for the entry level homes. So it's tough, not always easy, but again, have the right professionals. You select them, have the right professionals representing you to at least do everything you can to improve your chances of success. I have a required disclosures page because we talked about some sample loan scenarios, but that brings me to the end of the formal part of the presentation. At any point in time, you're welcome to reach out to me. I don't act as a loan officer. I don't take you through the process. If you want a loan officer, go to PhysicianLoans.com. My team will help you out. But if you want to bounce anything off me, or if you come across anything that just doesn't quite seem right, I love myth busting. If you say, hey, someone's advertising this, is it right? Anytime, feel free to email me. Always happy to help out. No, there's no charge. Part of what I do is in kind of educating our medical community.
Thank you, Tal. That was awesome. Really appreciate the information. To those of you that were with us today, just to give you kind of my own perspective going through this process in my transition to residency, because I've been literally in your shoes. You've matched in March. Now you're figuring out, getting ready for your programs. Orientations will start soon, and the academic year kicks off on July 1st. And so if you're near home, that's very different. I traveled all the way across the country, grew up in New York, ended up being out in California. And so, as Tal said, like, you want to get established with a realtor, you want to get established for that pre-approval as well, because that's going to give you the amount you're qualified for a loan, which gives you an idea of where you can live. Leverage your program coordinators, program administrators, trainees, attendings, or otherwise. They will know the most about the area, particularly if you're coming from an area that's not somewhere where you're from. Having never stepped foot in California until residency, I had to learn a lot about the area, and it was a very competitive market at the time, and I had to look at almost every home in a certain price range up and down the entire peninsula of the Bay Area where I was, and that was 10 years ago. It's now almost impossible for a resident to buy a home there. It was incredibly challenging to near impossible back then, which is why Tal speaks of location being a major driver of all of this. But, figure out what you're looking for. I bought a home that no one wanted. I was single at the time and had the ability to do that. Like, that in some ways can also make you more money in terms of appreciation. A lot of that has to do with how interest rates change and how the market changes over time. A lot of that, it also depends where you land for residency. And so the choice is very much a lot of different factors to yourself personally, how long you're staying in that area, what type of residency program you've gotten into. If you're in neurosurgery, you're going to be in an area much longer than someone who's in a transitional year or prelim year, or family medicine or pediatrics, for instance. And so you need to figure out that kind of piece overall. Why I've really enjoyed interacting with Tal and getting to know him and the Physician Loan team is they do know about physician loans. I can tell you my story, which ended up working out okay, but it was a whole process to even figure out what a physician loan was. When you look for a realtor, it's very much like matching into a residency program. Find a realtor who understands you. The questions Tal had are really, really important, and really, really helpful. But find a realtor that you can trust, who you enjoy working with, who actually understands you as a buyer. For me, I ended up working with a realtor who'd been in the industry 20 or 30 plus years. She grew up in the area. She knew the area really well. I'm still close with her to this day. I don't live in that area anymore. And I'll give a shout out to Barb. She was amazing then and working with me as a transitioning into residency home buyer at the time. And so a lot of this is very personal. You'll see people talking about it on mid Twitter or otherwise. Should I buy? Should I rent? If you have a buyer's mindset and you're okay with dealing with things that could happen, great. Also, in residency, you're not going to be in your home very much. If you have a family, they will be in the home very much. If you're single, the home's going to sit vacant for a lot of the time as you're working in the hospital. So all of these things come into play. The credit score is also very important, as we talked about in the last webinar also. And so, yeah, I think that I want to be cognizant of everyone's time, just kind of want to give that additional perspective of those that have been through that process. Some areas, they provide graduate housing. It's very cheap. It's very easy to get into. The area that I did residency, residents were last on the list of graduate housing that was almost completely unaffordable. And so it's very much dependent on your situation and where you are in the world. And so, yeah, I will open it up now to any other remaining questions and for Tal and team, and otherwise we'll wrap this up.
Thanks, Jason. I'm just going to interject real quick. Tal is pretty humble, and I know he won't say this, but I will say he is the one that created the physician loan program as a pioneer in the space. And so when he talks about the physician loan program, it is the original program. And while there's many out there, I think that, or well, not many, but there are a handful of others that are out there. You always just want to make sure that you're working with someone that understands the program. And there's a phrase that Tal had coined, the physician loan, because there's a lot of those that want to target physicians yet do not have a legitimate program. And so hopefully some of the material that Tal covered in this session will at least give you a heads up. I saw someone wrote, it gives them confidence. That's really what we want, is for you to have that confidence to go into this process, knowing the right questions to ask and having your antenna up so you know if you're hearing something that sounds good or something that doesn't sound right. But as always, use Tal or any of us as a resource, and glad to help.
Yeah, no, I agree. And just from my own experience, I used an actual real physician loan, but they had been through the process so few times that the underwriter had questions for themselves to even understand the loan program they were underwriting for. The loan officer wasn't as familiar with it as they should be. The realtor couldn't get the information that they needed. And so that's why having known Tal now for years, just his knowledge of understanding this process, it's like, it's like a fellowship trained surgeon who's used to doing a very particular type of procedure that's very, very specialized, but they do this over and over and over again. And so that's why I've enjoyed getting to know Tal and just having these discussions, but also as we put this webinar series together, it was just an obvious choice, given that everyone needs to find homes at some point, if not in residency, further on down in their career as well. And so the physician loan was a vehicle that allowed me to be able to buy my home. The market's very different now. People are in very different situations as well. There are lots of different things to consider, but overall, it's a great plan. And Talia, thank you for creating this as a vehicle, financial vehicle that exists, because it's certainly helping physicians and is life changing in many ways. And so,
my pleasure. Something, Jason, if I may add, the closing costs are similar for a conforming loan and a physician loan. And again, if we're the right company for you, great. If not, that's fine as well. And even if you're not working with us and you're having a challenge or you need some guidance or assistance, please feel free to reach out. But regarding the closing costs, something we started not too long ago, so this is relatively new, is if you do have a membership, if you are a AOA AMA member, which is oftentimes the case at many residency programs, there is also $750 credit off of the closing costs. And they're not, like I said, they're standard closing costs. It's not like they're bumped up and it's standard closing costs, base fees, as they say, like a conforming. So just putting that out there.
Yeah, no, that's great. I mean, that the closing costs are real money as well. And so that's really nice savings. And so, yeah, as you go through it, figure out what you're looking for in a home, figure out what you're looking for your career and your training. talk to your realtors, go through the process, and yeah, Tal and his team, I'm sure, would be happy to answer any questions along the way as well. So cool. All right. Any other last questions here before we wrap up?
Yeah, I want to make sure that we are answering everything. And Jason, if we keep this recording going, that's fine. Otherwise, can go through these. And like I see here, I see Danny's typing in and responding to a few. I see recent one came in. Jake asks, is that an exclusive perk of physician loans or available to any AOA member? It's only through physician loans if you are an AOA or an AMA member, because we are a member benefit through those associations. So that you must be a member of AOA or AMA and work with us. Let's see. Oh, I see Danny got to that just as I was. Is there a way to flag questions? There are a lot of, by the way, guys, I appreciate all the thank yous and all the very positive feedback. It shows us that we're on track. I don't want to waste anybody's time. I want to make sure this is helpful and you feel like it was a good way to spend an hour or so of your evening. So I appreciate all the positive feedback as well, guys.
I've been following the chat throughout. Either you or Danny have hit just about every.
Wonderful.
There's a question about inflation affecting home prices, and it certainly does because it affects the overall economy, but the market also tracks itself. And so how significant has it been recently? It very much depends on the area that you're buying in as well and the competition that exists there. That was a question from Marion, but otherwise I think we got most all of them. And so yeah, I really appreciate everyone for joining us tonight for the second part of the series. We'll take the next week off, so hope everyone enjoys the Memorial Day weekend. Please enjoy it as you're transitioning to residency and enjoy spending time with family and the time off overall. And we'll see everyone back again on June 6th for our next webinar with Practice Link about First Practice, the Resident and Fellow Career Guide. Start to get you thinking about your career beyond training, even though it hasn't started yet, but it's going to have some great resources to even just start thinking about as you go through the process. You don't need to worry about your career, just focus on training at this point. But thanks again to Tal and Donnie and the team. And so really appreciate it. Have a great evening, everybody. Appreciate you being here with us. And thanks to Sarah and Brooke from my team as well for helping organize this. So thanks so much. Hope it was valuable, and have a great night.